What's good, guys? Welcome back to my YouTube channel. This is Zedar Trades. Today we are going to learn the most important thing, which is the market structure. And let us look what we'll cover so far in this topic. Number one, we start with what is market structure in Forex. We want to know what is market structure. We want to see how market structure works. Then number two, we want to know the key components of market structure in Forex. Key components like price action, trends, support and resistance, swing highs and swing lows. Then number three, we talk about key phases of market structure in Forex. Key phases like accumulation phase, distribution phase. Then number four, how to identify uptrends, downtrends, and consolidation. Okay, uptrend is always bullish, while downtrend are always bearish. Consolidation is a sideways movement. Then number five, support and resistance level. What are support and resistance level? Number six, we have break of structure and change of character. What is break of structure, BOS, and change of character, ChoCh? We also have market structure shift in change of character. Number seven, how to trade using market structure in Forex. We know step by step how to trade using this market structure. Then we have number eight, how to enter and exit in the market structure forex strategy. Where do we put our entry point, our stop loss, and our exit point? We both know that today, and we will have examples of both trading scenarios, both uptrend, downtrend, and trend reversal. Then we also know the common mistake to avoid, which we always make on a daily: misreading the market, ignoring trend shifts, overcomplicating analysis. So if this is what you are looking for, make sure you hit the subscribe button, and let's start with what is market structure in Forex. Now, let us define what is market structure in Forex. Ideally, market structure in Forex refers to the way price movement form patterns and trends in the foreign exchange market, reflecting the interaction of buyers and sellers. It helps traders identify the overall direction of the market and potential trading opportunities by analyzing price action over time. So, in simple terms, ideally, market structure analysis enables traders to understand historical price patterns, which help them predict upcoming market movements. In market structure, traders tend to look at how the past price patterns has behaved so that they can use the historical price pattern to predict the upcoming market movement. After defining market structure, let us now look at key components of the market structure. Now, number two, we want to look at key components of market structure in Forex. The key components of market structure in Forex are the building blocks. Building blocks, which means without these key market structures, the market won't be complete. Okay? The key component of market structure in Forex are the building blocks that define how price moves and how traders interpret market behaviors. These components help identify trends which we will learn later, reversals, and trading opportunities in the market. The first key component we want to learn about, let's start with price action. In key components of market structure in Forex, number one, we have price action. And we can describe this price action as the price movement through time occurs without using indicators. We also have something called indicators, which we later learn. Through price action trading, the market demonstrates its response to economic events, which are news, example CPI, PPI, employment claims, and so much more, and trader sentiment. Trader sentiment reflects the overall attitude or mood of traders and investors toward a particular market, asset, or broader financial market. Okay? And supply and demand dynamics, which we later learn we know about supply and demand. Supply is where selling pressure is, while demand is where buying pressure is. The second key component of market structure is trends. In trends, we have three types of trends. The first one, it is in a uptrend, which is a bullish one. In uptrend, it is characterized by higher highs and higher lows. I'm gonna show it in a pitch with a picture in a while, indicating that buyers are in control. Okay, uptrend. Then the second one we have downtrend, also known as bearish, defined by lower highs and lower lows, showing that sellers are in control. The third one, which is a sideways or range bound, also known as consolidation, price oscillates between support and resistance with no clear trend. In this sideways trend, we have no clear trend. Let me show you how it goes. So, we have said that in uptrend, which is a bullish market, it is characterized by higher highs and higher lows, indicating buyers are in control. So let's say this is a market, this is our market. We are on a uptrend. The buyers push the price higher. We had a small retracement. Then price push higher, smaller retracement, higher, smaller retracement, higher, smaller retracement, higher, smaller retracement. Around here, price made higher high. This one is a higher low. We have higher high, higher low, higher high, higher low, then higher high, higher low, higher high, then price going to make a higher low. Okay, this is what is called an uptrend. Higher high, we usually write them on short form, higher low. Like that, this high, higher low, higher high, higher low. This is what is called uptrend or bullish market. Bullish market. Let us now look at downtrend. In a downtrend, which is also a bearish market, it is defined by lower highs, in short form LH, and lower lows LL, showing sellers are in control. Here, price was making lower highs, lower lows, lower highs, lower lows, lower highs, and lower lows. Then finally, this is a downtrend market, which means that sellers are in control, and it's also called a bearish market. Let us now look at consolidating market or sideways market. Then the last one, we have this sideways or range bound, which is also known as consolidation, which the price react between support, resistance, and a support level. We are going to learn about support and resistance as key component of market structure in Forex, the next one. So the market moves in high lows. The market has no clear direction. This one is resistance, this one is support. So this one is called a range bound market or a consolidation market. The market is consolidating. Let us now look at support and resistance is a key component of market structure. Market structure in Forex, we have support and resistance, wherein in support, a price level where buying interest, not the point, buying interest halts, declines, acting as a flow. Acting as a flow. This one is a flow, and we call it support. Is where buying interest start to come in, or where we start to look for buying opportunities. The second one, you have resistance. Resistance, it is a price level where selling pressure stops rises. This is where we start to look for sales acting as a ceiling. We have a floor, which is a support area, and we also have a ceiling, which is a resistance level. And this floor, we call it support. This is where buying interest hurts, meaning this is where buyer starts to comes in. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs to higher lows, to high highs to the resistance. A resistance is a price level where selling pressure stops, rises. This is where now sellers comes in, and this resistance it acts as a ceiling. So sellers come in to make a lower lows, lower highs, lower lows, lower highs, and lower lows to support zone. These levels are often psychological or historical. That's why we say market structure is about historical, where price tends to react. Price will create the same reaction in support and resistance level. Now let us look at the fourth component of market structure, which is swing highs and swing lows. The fourth key component of market structure in Forex is swing highs and swing lows. But before we look at swing lows, let us look at swing high. What is swing high? Swing high is a price peak where the high of a candlestick or bar is higher than the highs of the candles immediately before and after it. It indicates a potential resistance level where selling pressure may overcome buying pressure. So the price was creating higher high, then price created the low. This high, it is called the swing high. Swing high, a price peak where the high of a candlestick or bar is higher than the highs of the candles immediately before and after it. This candle, one, the first candle here, one, before this high, and before the and after this one. Okay, this one is the high, swing high, the last high. Then we have swing low around here. Then we have another swing high. Look at the first candle. This one is the first candle before this swing high around here. Before this swing high. Then this is the third candle after this swing high. Okay. Then you have another swing high. Look at the first candle before this swing high around here. This one is the third one after high. After this swing high, you have a third candle. They are lower than the high. A price peak where the high of a candlestick, the high of this candlestick or a buy is higher than the highs of the candles, the highs of the candles. This is the first one and the third one immediately before and after it. It indicates what? A potential resistance level where selling pressure may overcome buying pressure. This is the swing high. Now let us look at the swing low. Swing lows. What is swing lows? Swing low is a price trough where the low of a candlestick, or a bar is lower than the lows of the candles immediately before and after it. This is the opposite of a swing high. It signals a potential support level where buying pressure may overcome selling pressure. Now, let us look at the last candle, this one, and the candle before it, this one, and after it. First one, this one is the last candle, and after it, the three candle, it creates a swing low, which is this one, swing low. Then you go to high. Then look at this one, the last candle, this one, this week. Look at the candle before it and after it. This one is the last low, which is a swing low. Then it created a high. Then down, it It created the last candle. Look at the candle before it and after it. This one is called a swing low. Okay. Now, after understanding key components of market structure in Forex, which contain price action, trends, support and resistance, swing highs and low, now let us look at the third topic, which is key phases of market structure in Forex. So, just like the weather, which has phases, example winter, summer, you can describe them all. Also, the market has key phases. The market also has key phases. The market operates through recurring stages, which is a must. Recurring stages which establish the basis for price movement. Okay, the identification of these market phases enables traders to determine their current market position. Example, when it is rainy, you should carry an umbrella. When it is cold, you should wear a heavy jacket. Okay, just like the market phase, you should also be able to determine their current market position while predicting upcoming market development. The four key phases are: number one, we have accumulation, then we have uptrend, markup, this one going up, then we have distribution, just like accumulation. After distribution, we have downtrend or markdown. Let us start by looking at accumulation. In key phases of market structure, we have accumulation phase. Accumulation phase, this is the beginning, not the word. This is the beginning of the cycle. The market enters this phase after a downtrend. After a downtrend, it begins to stabilize smart money or big investor quietly begin buying at low prices. At this phase around here, the smart money starts to put their buying orders. Okay, the smart money start putting their buy orders at this accumulation cycle, quietly begin buying at low prices, but the general market isn't aware yet. The small traders are not aware. The big buyers are putting their orders at the accumulation cycle. Price moves in a range with no clear trend. You start seeing price moving in a range, up, down, up, down, up, down, up, down, up, down. There's a resistance here, the ceiling, and there's a support here, the floor. You start seeing price moving in a range around in a accumulation level. This phase often signals a potential uptrend is coming. After downtrend, if you start seeing price consolidating, like around here, after a downtrend, note that the big buyers are putting their orders around here in accumulation phase before markup. Okay, let us now look at uptrend, the bullish market or markup, the second phase after accumulation phase. Now, after accumulation, the second key phases of market structure is uptrend or bullish market. Others call it markup, others call it different name, but I prefer to use markup phase or an uptrend phase. What is this uptrend phase? The market breaks out of accumulation. Remember, accumulation is the phase for consolidation to start moving upward. This is known as a bullish trend. A bullish trend. Now the buyers are in the market. Let me now show you the chart which displays rising highs together with the rising lows, which means that buyers are in control and demand is stronger than supply. The rising market provides investors with favorable conditions to purchase assets because prices keep increasing. Here, we had accumulation phase, which you said is something like a consolidation phase because price was moving down, then up, down, then up, down, then up, then price break the high of this accumulation phase. Then buyers entered into market. Remember, this phase, the big investor are purchasing their assets. So after purchasing, price keeps going up, getting higher highs and higher lows. Okay, this phase is called a markup phase. Okay, markup phase. Let us now see the third phase, which is a distribution phase. This distribution phase. The third phase, we have distribution phase. Let's define it. Definition: a distribution phase is a consolidation phase. Remember, accumulation phase was also a consolidation phase at the top of an uptrend. This distribution phase is at the top of an uptrend, but accumulation phase, it is from a downtrend where the market pauses and selling pressure begins to build. Selling pressure begins to build means the big market investors begins to place their selling orders. Okay, this phase signals that buyers are losing momentum and sellers may be preparing to take control. We have this uptrend, which was which we called a markup phase or an uptrend, bullish phase. Then price started moving into sideways movement after uptrend. This sideways move, getting low, high, low, then continue getting high, then low, then price broke this low here, the distribution phase. This is what is called the distribution phase. Usually forms after an uptrend here. Let us look at the last one, which is downtrend or bearish market, which is a markdown. So after distribution phase, we now have the downtrend phase. Downtrend or markdown. Markdown phase. What is a markdown phase or a downtrend or bearish market? A bearish phase is where price makes lower swings highs and lower swings low, reflecting strong selling pressure. Remember when we learned about lower highs and lower lows? So we have this distribution phase around here. This distribution phase around here, which is a consolidation phase. The big market movers are making their orders. They are selling their orders. It is a distribution phase, a consolidation phase. After price breaks here, now the sellers enter into the market and it is called a markdown, which price makes lower highs and lower highs, lower lows, lower highs, lower lows. Okay, so after looking at the key phases of market structure in Forex, now let's just go to number 4, how to identify uptrends, downtrends, and consolidation. So I like to keep this thing simple. Let us now move to number 4, how to identify uptrends, downtrends, and consolidation. I keep them simple so it's easy to understand. Identifying uptrends, downtrends, and consolidations is key to understanding market behavior. Just like weather. When it's rainy day, sunny day, you know what to wear. It's the same as trading. So understanding uptrends, downtrends, and consolidation is key to understanding market behavior in trading and technical analysis. These terms describe the direct or lack of direction in asset price movement over time. Below is a clear concise guide to identifying it. Let's now start with uptrend. So, how do we identify uptrend? Uptrend, a bullish trend. So, an uptrend occurs when an asset price is consistently increasing over time, which means it buys over time without decreasing, characterized by higher highs and higher lows in price action. Remember when we learned about higher highs and higher lows. Now let us see how to identify an uptrend. Number 1, we have higher highs. Each new peak is higher than the last. This one. What I mean by higher is this one. So price is making higher high, higher low, higher high, higher low, higher high, higher low. This is how to identify an uptrend. This one is higher high, HH. This one is higher low. Then we have higher high around here. Then higher low. Each new peak is higher than the last one. This peak is higher than this last peak. Okay. Then number two, how to identify an uptrend. We have higher lows. HL. This one. It has higher high and higher low. This one higher low, higher high, higher low, higher high, higher low, higher high, higher low. Each pullback dip ends higher than the previous one, higher than this one. So the price maintained its position above both rising trend lines and moving average. You can also use an indicator called moving average with setting of 50 and 200 EMA to soften up the trend, how to know the trend more quickly. Most candles display bullish characteristics because they close at higher levels than their opening prices. Example, if you have a candle like this is a bullish candle, opening price is around here, then closing price is around here. Most candles display bullish characteristic because they close at higher levels than their opening prices. The next candle opening price will be here and the closing price will be higher than this opening price. Okay. And a tip, use a line or trend line to connect the swing lows. You will notice an upward slope. Example like this, higher high, higher low, higher high, higher low, higher high, higher low, higher high. You can use a trend line. A trend line is a line which it is found on a trading view. I will show you at the end of the topic. Draw, connect the swing lows, this swing lows. Remember when you talk about the swing highs, these are the swing highs, these are the swing lows. So connect these swing lows. Price might come and touch the swing low before going up again and again and again. Now let us look at the second one, how to identify a downtrend. Now, the second one, how to identify a downtrend. A downtrend occurs when an asset price is consistently decreasing, marked by lower highs and lower lows. Remember we learned about lower highs and lower lows occurs when price is on a clear downtrend. The following steps helps identify a downtrend. Number one, lower highs. LH. Each rally ends lower than the previous one. You have this one, lower lows, lower high, lower lows. This one is lower high. Then we have the lower low around here. Then another lower high. Then lower low. The second one, how to identify a downtrend. We have lower lows. Each drop pushes price to a new low. Each drop. Remember, this is the high and this is the drop. This drop here, it is supposed to call, it is called a lower low. L, L, lower low. And this one is a lower high in a downtrend market or in a bearish market. The price remains below both a descending trend line and moving average. Now, let us look how to identify consolidation or sideways market. First, consolidation occurs when an asset price moves sideways, meaning there is no clear directional trend, often within a defined range. Now let us look how to identify consolidation. Number one, price bounces between resistance zone, which is top. Remember when we said the ceiling, and support zone, bottom. Remember when we talk about the flow, right? Like this. You have the ceiling, resistance zone, and you have the flow, the support zone. Price bounces between a resistance Price bouncing from here, resistance to support zone, bottom, and again, and again, and again, and again. This is what is called consolidation. How to identify consolidation. Number two, the market lacks distinct higher highs and lower lows, meaning there are no market is not moving like this, creating lower highs and lower lows, or moving like this, getting higher highs and higher lows. Market is moving on a sideways. 3. The candles display alternative bullish and bearish patterns by showing frequent overlap, meaning there's no trend which is strong, either bullish or bearish. There are no more buyers or more sellers. They are just all equal. Volume and momentum decrease. Common shape include rectangles, flags, and triangles. These are shapes which we would also later learn. Tip: draw horizontal line at range boundaries to identify consolidation when price remains within that zone. If you see price behaving like this, draw horizontal lines, these ones, to identify consolidation. Now, let's go to number 5, support and resistance level. This one is the most important. The forex trading market relies heavily on support and resistance zone, which form the foundation of market structure. In forex, without support and resistance level, there will be no market structure. Support and resistance level are key concept in technical analysis used to identify price levels where an asset price tend to stop, reverse, or consolidate. You have the resistance zone around here and support zone around here. You see the price comes here at support zone, which is the floor. Remember what we learned first. The support zone acts as a floor and the resistance is a ceiling of a house. So price came to the support level, stops, moves up to the resistance level, then stops, it comes down to support, then stops, resistance, stops, support, stop. This is a form of a consolidation. Okay, so let us look in details the support zone, the support level. Let us look at support levels. The market price tends to stop its downward movement at support level before rebounding upward. Let's say here the market was selling up to here. So the market stops its downward movement at support level around here. Stop, it comes here and stop. It comes here and stops. It comes here and stop. This is what's called a support level. So the formation of a support occurs when buyers step into the market to elevate prices to make price go more higher following a downward trend. So buyers may find time to enter the market around here support level. You buy around here to resistance level. The price finds a floor. Remember when we call this support level a floor. A floor. I usually call it a floor. And this resistance I usually call it a ceiling. So the price finds a floor at this level, which prevents it from continuing its downward movement. Okay, let us now see resistance level. Let us now look at resistance level. Resistance. Remember when calling resistance a ceiling, it's like a house, a ceiling. Don't forget that the opposite of resistance exists as a price level, which tends to stop increasing before pulling back. Let's say that the buyers were in control of the market. You buy around here at support level. You push the price high to the ceiling. The buying will stop around here before the sellers decide to come to the market to push the price to the support level. The price stops rising when sellers enter the market to stop its upward movement. The price stops rising when sellers enter the market to stop its upward movement. So the sellers enter the market around here, the resistance level, this level here is the resistance level. The sellers enter the market around here and push the price lower, stopping the buyers from buying. The price finds a ceiling that prevents it from rising further. So guys, let us now look at number 6, break of structure and change of character. The forex market requires traders to understand break of structure and change of character because this concept help identify market trend direction and potential turning points. So let's start with the break of structure first. What is basically a break of structure? BOS. A break of structures occurs when the price breaks a significant level in the market structure, signaling the continuation or strengthening of a trend. If, for example, we are on an uptrend, this high, like this, when price break this swing high around here, we call it BOS, break of structure, BOS. Then price shows continuation or strengthening of a trend, then it shows retracement, then price then comes again up to break this swing high. When price breaks this swing high, this level is called a break of structure or BOS. Then price then climbs up, continuation or strengthening of a trend. Then price starts to show retracement. After that, price comes, grab the high, this swing high. After grabbing this swing high, we mark this level as a break of structure. It typically confirms that the market is moving in the direction of the break, often indicating that buyers or sellers are gaining control. This is a bullish move, which means that buyers are in control. On a bearish move, we have this one moving down, showing retracement, down, showing retracement, down, retracement, down. So price came to this level, created a swing low. Remember, in a bullish trend, it is a swing high, bearish, swing low. Then price retraced, then came down, showing a continuation of sellers. Here, price break this level. After price breaking this level, we call this level a break of structure. After price breaking this level, we call this level a break of structure. So price continue with the trend. Then we had a retracement. Then price came, broke this level. After breaking this level, we call it a break of structure. Also price came, showed a retracement, came down. We call this level a break of structure. I will show it in a chart. Let us now look at change of character. The change of character indicator indicates that a trend reversal might occur. What do we mean by a trend reversal? That means that when, for example, we are on an uptrend, price creating higher highs and higher lows, higher highs and higher lows, and it decides not to break that high, and it breaks this low, this swing low. Then price come like this, then continue breaking the lows. I want you to understand something. The change of character indicator indicates that trend reversal might occur. Trend reversal. We are on an uptrend, but price came here and failed to break this high, but broke this low. Okay? Price came and broke this low. When price break this low, we call this change of character. ChoCh. Let me write it here. Price didn't break this high, but it broke this low. After breaking this low, we call this change of character. And a trend reversal might occur. A trend reversal meaning that when we are uptrend, we are now going for downtrend. You might see price start to behave like this, getting lower highs and lower lows. Okay, here price was creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Price didn't break this high, it came for this low. So we had a confirmation of change of character. then price retraces, and it came and broke this low to create a break of structure. Remember, this high is a break of structure, and it didn't break this high, but it broke this low. After breaking this low, we call this low a change of character. Okay, after change of character, we had the retracement, change of, then we have a break of structure here, and so on and so on. The price breaks through the opposite side of the existing trend structure to trigger the signal. Simple. On a downtrend, let's say price was creating lower highs and lower lows, lower highs and lower lows. Then price came like this. It didn't break this last low. Okay. Here we had a break of structure. We had a break of structure here. We had a break of structure here. But it didn't break this low, but it broke this high. It broke this high, last high. So after breaking this last high, we expect the market to change the direction to move more higher, creating higher highs and higher lows. So after price breaking this high, we call this higher change of character. ChoCh, short form ChoCh. I will do all this on a chart. So relax. ChoCh, change of character. You have a change of character here and break of structure moving towards the upside. Now let us go to number 7, how to trade using market structure in Forex step by step. So you have learned about market structure. You have known all the details about market structure. You have known change of character, break of structure, swing highs and swing lows, change of character, and all that. Now, how do we use this concept to analyze or trade or to trade? That's why we are going to number 7, how to trade using market structure in Forex. We start here. Trading Forex using market structure involves analyzing price action to identify trends. You first identify trends. Remember, we have uptrends, downtrends, and consolidation. We also identify reversal and key levels. Key levels where price is likely to react. Key levels, we talk about them, are support and resistance. Market structure refers to the way price moves through swing highs. We talk about swing highs and swing lows, forming pattern that indicates bullish, bearish, or ranging market. Remember, a consolidating market. By understanding concepts like break of structure, which we learned in our first topic, change of character, and key levels, e.g., example, support and resistance, order blocks. I will soon post about order blocks. I will put a link there. I have a video which talk about order blocks. I put a link there. You can check it right now up here. A video about order blocks. Traders can make informed decision about entries, exit, and risk management. First, let's go step by step how to trade using market structure. So step by step, number 1, we start by identifying the market phase. What do I mean by market phase? We first check the chart to determine if the market shows an upward trend or a downward trend or remains stable. Let's start with upward trend, this one, getting higher highs and higher lows. This one is on a upward trend. Or we check if the market is on a downward trend, creating lower highs and lower lows. Or number 3, we check if the market is on a stable phase. Stable phase means consolidating phase. This is the first step to use the market structure. We first identify the market phase. Step number 2, we analyze the swing highs and swing lows. This is step number 1, identify the market phase. This one. Step number 2, we analyze swing highs and swing lows. Let's start with an uptrend. This is the last one. We call it a swing high, and this one is a swing low. Then this high, swing high, swing low, swing high, swing low. Identify the essential swing highs and lows to determine the current market structure, because highs and lows are either rising or falling or remaining flat. This one is rising, which means the market is on a uptrend. We have identified the swing highs, swing lows, swing highs, swing lows. For here, you have the swing low and the swing high. This is the opposite of an uptrend because it's a downward move, a downward market. Swing low and swing high. But this one, it remains super flat. It's a consolidating market. The third step, we watch for break of structure and change of character. This is number 2. Then after knowing where swing highs and swing lows are, number 3, we watch for break of structure or change of character. So when in an uptrend, we want to confirm where the break of structure is. The break of structure means when you break this swing high, you break it here, we'll be having a break of structure. We have now identified break of structure here. Price continue going up, then comes down, then price break this swing high. When price break this swing high, we call it a break of structure. We have identified break of structure. Then the last one, this swing high, price break it. After price breaking this swing high, we call it a break of structure. After analyzing the break of structure, price came here down. Let me draw a line here. So we have a break of structure, but something happened. Price created the last swing high, then we broke this low. After breaking this low, which means that buyers are now starting to take their profit here and sellers are entering the market. We have a change of character. Price breaking this swing low means that we have a change of character, ChoCh. Okay guys, now we have sellers. Sellers coming to the market and the trend continue like that. This is an uptrend. The second one, change of character. When in a downtrend, we want to identify break of structures and change of character. So we have this swing low, swing high. Price break this last swing low. We had a break of structure, BOS. Then price came, created a swing low, then swing high. It broke this low to create a break of structure. Price came, this last swing low. It came and grabbed this to create a break of structure. Then suddenly the market shifted upwards to grab this swing high to create a change of character. Hope we are together. Then price retraced. Then it continues going up. Okay, guys. After that, the last thing, number 4, we want to confirm if there is support or resistance level. So the last thing, number 4, we want to confirm support and resistance level. This is number 4, the last thing. Example, if price was reacting above here so much, and we also have price reaction up below here, the floor and the ceiling, this will be a resistance level, which means that sellers were entering the market around here, but we must confirm by a change of character around here. Okay, and if price was reacting around here, the support level, the floor, the buyers will become and starting to react here, price push-ups, and we are waiting for change of character. Okay, same apply to the downward market, downtrend market. Let's say we had a support, we had a resistance around here and support around here. This resistance is where we sell to the support level. Same as the consolidation market. Price consolidated, we have a resistance around here and support around here. So price came to the support level, the floor, it bounced to resistant, support, bounce to resistant, support, and on and on. Let us now look at number 8, how to enter and exit in a market structure in Forex before we look at the real examples in a chart. Before we go on a real chart, let us look at our entry and exit when using the market structure. On our entry, we need to enter trade after a clear confirmation of trend direction or a break in structure. For example, in an uptrend, buy on a pullback like this. You have this pullback, then price continue going up, breaking the structure, pullback, then going up. From this high to this low, it is a pullback. This is a pullback. We buy using this a pullback. We can also confirm by using a Fibonacci retracement, and I'll put a link up here on how to use a Fibonacci retracement tool. You can also buy after this break of structure. We wait for a pullback, another pullback at 50% level of Fibonacci retracement. I'll put a link up there so that you can know how to use Fibonacci retracement level. You buy at a pullback or to a support level or after a break of structure. Maybe there can be a support level around here. You buy at this support level. At every break of structure, there should be a support level. The first thing you should identify the trend. Example using 4-hour time frame. I will show you this on a chart. It is a bullish or a bearish. You look for higher highs and higher lows. Wait for pullback and etc. An exit strategy. Let us look how we can exit. To exit a trade, we should set take profit targets near strong resistance in uptrends or supporting downtrends. Example, we have this uptrend, then there's resistance around here. This is how we should take profit. Then on a downtrend, let's say we have a support around here, a floor. This is where we will take profit when we are selling on a support level. On take profit, we take on a resistance level. We use something called trading stop loss. Trading stop loss is moving a stop loss to break even. Let's say you have entered the market around here and you're in profit and the price is around here. You wait for this pullback, then you wait for break of structure. If price break this break of structure, you put your stop loss below here. That is what is called a trading stop loss, so that you can lock in profits as the trend continues. That makes your loss to be minimal. Let us look how to place a stop loss. So we can place our stop loss just beyond recent swing highs or lows to protect against unexpected move. Let's say we are on an uptrend move and we decide to buy after this break of structure. We buy after this break of structure. We will put our stop loss to this swing low. As the price continues going up, we will put our trading stop loss below this. Okay. Now let us look example of trading scenarios on a real chart. I'm on a Euro USD, Euro against US dollar chart, and as you can see, price is making higher highs. Let me mark with this path. Price is making higher high and higher lows. Higher high, we first identify trend and higher lows, then higher high and higher low. Price continue with the trend and so on and so on. What we want to do first, we want to identify the trend, and we have identified the trend. Price is making what? Higher highs and higher lows, higher highs and higher lows, which means that we are in a uptrend. And the buyers are in control. Buyers are in control. So what we want to do next, we want to identify the break of structures and change of character. The first thing first, the price made this move from here, this high. Remember, we want to look at the last swing high so that we can mark our break of structure. We look at this last candle, this one. the red one, this one. Let me zoom it clear. This one. Then we look at the last before this candle and this one before, the two candles. So we mark this swing high. We mark this swing high and you wait for candle to break that swing high. If a candle break that swing high, then we call this level what? A break of structure. BOS. Break of structure. Again, price continue to rally up. This downward movement. This one is the last swing high. We mark that swing high, the last swing high, this one. We mark it and wait for price to grab that high. After price has grabbed that high, we call this level break of structure. Okay, then we have this another pullback here, swing low. Then this one was the last swing high. We mark it with a arrow. We call it a wait for price to grab this high, and then we call the level a break of structure. Then price continue to rally up, and then there's this what pullback. Then this last swing high, this last candle, this one, last swing high, we wait for price to grab it. If price grab it, we'll be having a break of structure. But if price fails to grab it and price make this move, comes to this low and grab this low, let's say price has grabbed this low, we'll be having a change of character if price grabs this low, which means that sellers are coming in the market. Which means that sellers are coming into the market, and we wait for confirmation before deciding to sell. Confirmation is what? Either pullback, 50% of Fibonacci retracement level, then we sell and we see price going to the next level, next low. Okay, so how do we enter in these scenarios? We had this high, we are waiting for price to break it. If we enter here, if we enter above, let's say we enter a long position around here, after price has break that position, our stop loss will be around this last swing low, and we target what? We target 1:2 risk to reward. We target 1:2 risk to reward. But that sometimes can be so risky. What we do, we wait for any pullback. But we want to enter on a 50 Fibonacci retracement level. So we take our Fibonacci retracement tool here. We mark from this swing low. I have put my Fibonacci video. You can watch it and know how to use Fibonacci retracement tool. We mark from this swing point and we wait for any retracement level. Let's say price retracement to this 30 level. We enter here. We put our long position around this level and stop loss to the next key level around here. We target 1:2 risk to reward. Okay, guys. Another entry strategy. Let's say you want to enter here when price make a pullback. This is the last swing low. We take our Fibonacci tool, retracement tool, wait for 50, 60 level. Like this one. We have our 60, 50, 60 level around here. This one. So we enter around there, a buy, and we target 1:2 or 1:3 risk to reward. Let's say we have entered a long position here. We target 1:2 or 1:3. Stop loss to this last swing low. Our target is not yet reached. So that's how we enter. Although I've not talked about everything, I have not given out more example, but this is how we trade it. Guys, I have not talked about everything. but if you, I will be continuing this video, so make sure you subscribe, give me a like. It took me hard work to record this video, but let me know what you want to be let me know what you want to learn next, and I will record that video. So guys, make sure you subscribe to my YouTube channel, and see you next week.